Welcome to It's the Economy. Even as the stock market indexes dither near all-time highs, the bond markets have exhibited unusual swings by bond market standards. In March, remember, the 10-year bond yield ruled as high as 7.46 in the first week and over 4% in the US on steaming inflation numbers. But by May, the yields had fallen to below 7% in India, 6.94 on a day, and below 3.5% in the US. Again in June, the yields have seen a sharp rise on fears that the Fed is not done with rate hikes and that the Reserve Bank is nowhere near a rate cut. As far as rate sensitives go in the equity markets, the surge in bank stocks is now getting replaced by a surge in NBFC stocks. To get more perspective on where interest rates are headed, where bond markets, NBFCs and other rate sensitives are headed, I have with me someone who perhaps is the last word in the interest rate market and on financial institutions. Ashish Gupta, now in a new avatar, Chief Investment Officer at Axis Mutual Fund. Ashish, thank you very much for dropping in.
Thank you for having me.
Made an appearance in your new avatar. Okay, so first up, exactly this question. You know, we saw yields fall almost 50 basis points after the February rate hike by Reserve Bank and after the budget. But now a bit of it has been given up. What is your view? Do you think that we have more to see rate increases, yields increases?
Actually, I think particularly if we talk about India, I think we can be a lot more confident that we are past the peak in rates, right? I think where the question lies is what is going to happen in terms of the pace of rate cuts. I think even global yields, yes, Fed has indicated there are a couple of more rate increases possible, but long yields I think are at peak or close to peak. I think the recent increase in yields that you have seen is probably market realizing that the rate cuts will not be as quick to come as it had anticipated. So back in March, I think as first signs came that the inflation is rolling over, people started, I think, too quickly building in that rate cuts will also come on back. I think if you look at US inflation, it has been a bit stickier than expected, and particularly core inflation. Therefore, I think people are now kind of getting more pragmatic that rate cuts will not come as quickly, and that's why I think you have seen this recent pickup in yields. But I think we can be fairly confident that peak of rates is
past both in the US and in India. Certainly in India, 7.46 is not in anyone's book. But what about the recent increase from 6.95, the 10-year has come to 7.0607 in the last 2 days. Is there more to go? Because somehow the arithmetic now is looking adverse. The big buying by insurance companies, whatever lagged money they got last year appears to be over now. HDFC Bank buying is over now.
So I think short-term movements are also driven a lot by really demand-supply dynamics. If you see in the month of March, all of us in the bond markets as well as insurance companies really had a spurt of inflows because of the tax changes. So I think there was some bit of pre-buying. Also the government's new borrowing calendar started to kick in now. So I think it's more to do with these short-term variations rather than really a view that on interest rates fundamentally changing.
Okay, no, I take your point. There was in the debt market tax caps also were not there. That 20% advantage we had was gone. So I guess all of you all had a lot of money as of FY23, March 31.
So I think there is data out there.
You think all that money is run out now?
Yeah, so basically, I think some of the buying got upfronted because the money came in quicker in March rather than coming over a couple of months.
Fair enough. But even now, is there space for yields to rise more simply because there is an El Nino fear hanging over our heads? And at least the monsoons from a Bombay point of view are looking a bit scary. So can this fear push up yields? As well, I don't think in the second quarter there are too many redemptions. Even if you look at the GSEC calendar, clearly issuance is far more than redemptions.
Yes.
So can we go to like 715, 720? Is that a possibility?
So we are actually not expecting that. I think, yes, there is some risk to inflation because of El Nino. But again, the magnitude that is being talked about is 20-25 basis point. And if you look at inflation in India, the last episode, actually it was primarily driven by WPI. So it was WPI dragged CPI up. If you recall, last year WPI went into double digits and that took CPI up. If you see recent prints of WPI, they are actually negative, right? So now actually WPI is dragging CPI down. So we are not really very pessimistic about inflation in India. I think RBI has got it right that inflation is rolling over.
Downward trending. Yeah. Perhaps the peak is over. 6.5 is the repo rate. That is clearly the concern. But when is your first rate cut penciled in?
So we are actually hopeful that by the year end we'll get at least one rate cut. I think
that is fiscal or calendar?
Fiscal year.
Okay, so Feb or
yes. But I think more than really inflation, what we are looking at growth, right? And I think RBI will watch for growth. So if growth starts slowing perceptibly, I think that is something that might trigger more action in terms of rate cuts rather than just inflation.
Time permitting, I'll pursue this a little more because the governor sounded very clear that until he sees 4, he is not, I mean, that's his goal.
Yes.
And their own forecast for the fourth quarter is 5.2.
Yes.
So, I mean, it didn't look like February when
but
he was
I think
speaking.
Their forecast of growth is probably stronger than our forecast.
Yeah, that's right. Okay. Where do you stand, by the way, on growth?
So we don't have an official forecast, but frankly, I think India getting 6.5% growth has really happened in a weak global environment, right? So I think the last time we saw was only in 2009 when economy grew at more than 6.5% when global growth was weak.
That's a little difficult.
Yes.
Okay, I want to quickly come to NBFCs and banks since you are the high priest in that area. We are seeing a lot of offerings from NBFC and the mood in the equity market is that a long cycle starts.
Yes.
Would that be a fair point? I mean, as a CIO, also you have to take a call on NBFC paper.
No, so actually in some of our funds, we are overweight NBFCs. I think we have seen both on the asset quality cycle, NBFCs lag the banks in terms of recovery, primarily on account of 2 segments. They had a high share of real estate loans and on microfinance. If you see data over the last 9 months, even on those 2 segments, asset quality has stabilized, delinquency levels have actually come down. I think that is also giving more confidence to NBFCs to start growing. And if you see March quarter was the first quarter where NBFCs growth started matching bank growth. Otherwise, NBFCs were growing slower than banks.
Yeah, actually, I think in the fourth quarter, some of them have grown faster, maybe twice the clip of banks.
Yeah.
But basically, would you, as a fixed income, investor or chief investment officer, would you prefer that people go into more corporate paper? Is credit more reassured now? So, why
Definitely.
would you go to a Government of India paper? Is it a better deal?
No, I think corporate
funds?
credit paper is very, very comfortable at this point of time. I think if you look at all leverage matrices across the corporate sector, that is comfortable. Even as we are seeing capex being planned by corporate India, we are actually not seeing that being planned so much using leverage. So most of capex is coming through accruals or equities. So we are actually fairly comfortable about corporate risk at this point of time.
How long do you think this NBFC cycle can run? We just yesterday had a JP Morgan paper saying that this NBFC cycle looks like a 4 to 5 year cycle. It looks as good as that?
So I think we have to really look at NBFCs individually because I think we always find that people who know the segment well are able to gauge the quality of credit they are taking. And we are already seeing, so for example, in segments like unsecured loans, there's a large gap in the delinquencies you are seeing between traditional lenders and non-traditional lenders.
Okay. So you'll pick and choose over there. And what about banks? Final question, since we always turn to you for banks. Is it like the NIM advantage has run off and you have question marks on growth? So even both volume and margin could be under pressure this year? At least that's the behavior of the stocks.
Sure. No, I think you will see some moderation in both, right? But I think where the margins are, they are very, very comfortable. So even if they come off a bit, I think banks are going to be a lot more profitable than they have been in the last 10 years. And thankfully, the markets are also not pricing in very high NIMs for the banks. So the valuations are actually also very moderate, even for the largest banks in the country.
Okay, so banks and NBFCs for the picking. That's the word coming from someone who I regard as the high priest of the financial sector. Unfortunately, out of time, we have to wrap up on Bazaar. Chartbusters up next, and let's see if Chartbusters or Trading Hour is lucky to get the all-time highs.